Okay, Bus Bench Babes, the episode everybody looks forward to every year. We have the mortgage forecast for 2026. We brought back one of our favorites, Elly Cummings with New American Funding is with me today, and I'm peppering her with all the questions. What do you want to know about? Do you want to know what it's like to be a renter and maybe you should be considering buying a home? What does it look like as a buyer? The Fed chair's term is up and we're going to have a new Fed chair in 2026. Like, I'm asking Elly all the questions and you're going to love this episode. Let's dive in.
You're listening to the Girl Get Your Face Off a Bus Bench podcast, where we invite you to check your ego at the app, grab a cup of coffee, and get ready to dive into all things real estate marketing, social media, friendship, hardship, love, money mindset, and all the things that celebrate you as a badass boss babe.
We're here to encourage you, show up for you, give you a loving kick in the pants when you need it most, and be your soft place to land on the hardest of days. So pull up a seat at our table and get ready to be inspired and start living your best life by design.
Welcome to the Girl Get Your Face Off a Bus Bench podcast. We are so excited you're here.
Okay, girls, let's dive in. All right, Bus Bench Babes, I have a special treat for you. I have Elly Cummings, one of the EVPs with New American Funding. We have her back again. And the reason we keep having her back is because this is the gal that knows her stuff. So we're like, why? We just need to get it straight from the horse's mouth. So that's why you're here. So thank you so much for being here. You and I have known each other for years, but tell the audience a little bit about yourself.
So thanks for having me. It's always fun to hop on here with you. I was speaking at a conference the other day, and I had one of those holy cats moments because I'm 28 years in the business, and it's a math problem to me because I'm like, how am I adult enough to have been doing anything for 28?
You're like, I'm 32 years old. How is this possible?
I'm like, the math's not mathing, and I'm like, holy smokes, it sure is. So 28 years in mortgage, doing literally everything, most of it on the sales side of it, but I've been all over the place. So obviously interest rates is something that comes up in my day-to-day life, working with a team of about 400 LOs in the dirt, so to speak, that I cover. So it is at the forefront. I can't get away from it. And anyone who follows me on Instagram might roll their eyes because they hear me talking about it probably on a weekly basis. But it's important, and it's important, I think, to know more about it and to not get scared off by everything else that you see or make uninformed decisions. But
yeah, so that's what we're just ripping off the Band-Aid. I have a whole slew of questions, and I knew that we had to have you back on because this is stuff that you eat, breathe, sleep, all of this info. And I like that you always come at it with a really level-headed approach. You're not doomsday person. And so I'm like, let's look at this from a good spin, but really use facts and stats. And so let's just do it. Number one, based on current trends, what are your predictions for interest rates in 2026? And what factors do you think are influencing those predictions?
So this is a fun one because there's a lot of things in there, but I will say for 2026 right now, the tea leaves, so to speak, really say that rates are going to hover around that 6%, handle, give or take maybe up to a half a point. It is right now. We have seen for the last few months, we've really seen some easing in rates, which is great, but there's not a ton that's on the horizon that we really think is going to move the needle to some drastic swing either way as we get into 2026. There's a lot of data out there, the agencies, Fannie, Freddie, have already got their forecasts out there. The MBA has their forecasts out there. All the real estate economic greats that put out really good data have their forecasts out there. In the low end, the most aggressive is maybe 5.9 through the year, and most of them are around that 6.25 range. But overall, that's a super healthy market and a super good place for rates to be. Because I think about it when we're talking lending money for 30 years, nobody can sustain lending money for 30 years at 3 and 4%. So like
Yeah.
that was a gift that we had when it happened, but it's not like it doesn't stick. And it's like we are at a good place. I think there's some things that could move the needle more, but we're really like we're in the spot that we're probably going to be at for a while. But it's a good affordable spot, and the best thing is seeing some of the whipsawing slow down because nobody likes that when things swing from 6.5 to 7.5 to 8%. I mean, we were on here 18 months ago and rates were like, I mean, it was a lot of people were really down and out because rates were, I mean, we were locking loans with 8% interest rates depending on certain situations.
I know it's crazy, but people were still buying houses.
Correct.
You
Correct.
guys were still doing great. The BPR was still doing great. I mean,
Yeah,
if you have to buy and sell a house, you got to buy and sell a house. You can always refi later.
absolutely. And I think like I just have to say this too. I am a really big believer that a home buying decision, any big decision, shouldn't be based on a rate itself. It needs to be based on affordability and payment. So like rates aren't vanity symbols anymore. Like they became, cocktail conversation of how low is your rate and mine's this. And that's just, I mean, 20 years ago we didn't have those conversations. It just came into vogue, so to speak, when rates were ridiculously low. But on the flip side, the economy was really hurting when that happened. Rates got that low because we were in the midst of a global pandemic and people were out of jobs. They weren't getting paid. There were so many other factors that were terrible in that wasn't just like some great time.
Yeah, I feel like that's the part that so many people outside of the industry forget is that like the world is like has to crash in order for rates to do something like
Right.
that. Like in my history, it was 9/11 and it was the pandemic. And so I'm
Yeah.
like, I don't want either of those things, even like half of one of those things ever again.
Yeah. I amen to that because it's the things that we really watch that go into it. Like right now it's all about inflation and where that's going, and that is anybody's guess because we see it's really hard to predict. I don't think that we're out of some of the pain right now that is gonna, because we are seeing jobs numbers soften a little bit. And again, if rates ease because of that, they're easing because people are out of work. And that on the flip side is not a great thing. So we all have to remember that lowering rates to stimulate a faltering economy is really not great. We're in a lot better position. Everybody is. If rates are a little bit higher and the economy is good, your 401k is better, what you pay for a car loan is better. Like everything is more in line when things are stable.
That's a really good reminder. Well, you talked about inflation, so that leads into my next question. How do you see inflation impacting interest rates over the next couple of months, but particularly next year?
Oh God, I mean, it's at the forefront of it. I think that we're kind of sticky in this like 3%-ish range, and that whole Fed target of getting down to 2%, I don't think is realistic because there is a lot of things about inflation that don't go away. Like the reality is we're never going to have 99-cent hamburgers again. You're never going to go to Starbucks and get a cup of coffee for $1.50.
No.
Things are going to stick. And so although like fuel and other things will vary and those can go down in trade, a lot of these things that we measure, we're at a new baseline. So getting down lower to that target is going to be hard. Like I think we're going to sit in that sub 3% range. We'll get lower, but it is so then it becomes a little bit of a conundrum because we have to look at other things because it's like when that doesn't move as much and we can say inflation is controlled because things aren't skyrocketing any longer, I don't think it will have as big of an impact on rates as much as like jobs will and manufacturing and this other stuff that is going to affect it.
Okay. Well, like, it's like you're reading my mind. The next question, like, what role do you think the Federal Reserve will play in shaping interest rates in 2026? Or like, what signs should we be on the lookout for with like the monetary policies?
Yeah, and they are. It's kind of a cliche term, but so far in my history, the foreseeable past of we'll call it 28 years. The Fed's a bit of a one-trick pony when it comes to this. They look at the same things, and those aren't always the best indicators. I mean, they're necessary indicators, but you can be stuck on a CPI or a PPI number, and that number can read one thing, and you're going to see other signs in the other signs of the economy that are going to almost conflict with that. So you can have one of those that shows it's coming down, but on the flip side, we could see that is coming down, yet we're having trouble in jobs and manufacturing that are kind of arguing against that. So they're gonna stick to something around, they always will, about the CPI and the PPI numbers, the core inflation. But the biggest thing that I think to be on the lookout for and to be watching, because these are more real-time and indicators far before we get that, is really what's happening in manufacturing and what's happening with jobs. And we have had some really big misses this year on the jobs numbers, and they do revise them down, and they can revise them down like months later. Okay. So when we're looking at that, the real signs of spending are that, like jobs, and then turn around and look at credit card debt and that type of stuff, because those are indicators of where people are really at. So although the Fed might say inflation is coming down and we like these numbers, you see the prices, the grocery bills aren't coming down, and credit card bills are going up, and we have more debt in the US than we've ever had. So those, I think, are more impactful than some of the actual numbers, and keep an eye on those. And unfortunately, when we see jobs going down and debt going up, that probably means we could see some softening in rates. But then something that's just worthy to point out, and I feel like I've just been droning on about this, is everything happens in arrears. We think that the market's already priced in these Fed cuts. So when the Fed cut a quarter last week, that had been priced into the market for 6 weeks, maybe longer. And they start with all the different modeling. So they, like mortgage rates actually went up about a quarter when that happened, because that was priced in, and there was a 38% chance priced in that they would cut even more. So then when they didn't cut even more, we go up. So it's you almost always see the inverse. So when the Fed cuts, the actual rates usually go up, not massively, but it's like they don't correlate. So it is a bit of a misnomer, but it's good for people to hear that there is not that correlation. When we talk about the Fed funds rate, and when you see that, because that's what you hear on the news, that's the overnight rate that the banks are lending money to each other with, that they're getting money from the Fed on, and that they can borrow each other. That's not what we as consumers are paying in any fashion.
It's totally misleading to the average consumer. That isn't like like even before I got into the business, I'm like, oh, that I didn't, you just hear that and you're like, oh, well, that means the rates are coming down. You're like, well, no, exactly. That isn't how that works.
Yeah. And it might it will affect some of those really short-term rates. Like if you have a prime-based HELOC or something, like things like that, but it really isn't, it's not that needle mover that people think it is.
Mm-mm. No, but we have been seeing rates coming down. So that was all ahead of time, in anticipation of
that. And it was really September was pretty notable of when we started to really see them. And it's always interesting because so often in this post-pandemic world, it has been, unprecedented has become almost a cliche word because it's used so often in this, because things aren't following the data in the same patterns that they used to, because there are so many anomalies. Like I had said, you can have an inflation number that signals that we're going in the right direction, but then you have a jobs number in the tank that it's like, well, those don't go hand in hand. So the market can be confusing, to say the least, on it. But in September, when we saw the rates come down, you kind of wait to cheer or think that it's going to stick around, because we see that happen for a week, a couple days maybe, and then they go back up, and they'll swing. They can swing a half a point in a couple of days' time if the market is volatile enough, and it certainly can be. But we've been now more stable, where outside of them going up a quarter when the Fed went down, they've come back because there's other data that's coming out that's not so great. So it's like we've been able to hang on in a range where rates, prevailing rates, really do start with a 6, and that's a good thing.
Yeah, I think that feels like a really great rate. And it's shocking how many buyers though are still sitting on the fence. Like,
Yeah.
what are you
And
waiting for?
I mean,
Like,
you
we're
want to
not getting
go, oh
3%
my God.
again.
Like and with that too, there's so many good things right now. And I mean, I'm sure you know this better than anyone and geek out over the data, but this is the time of year where you typically get the best deal, so to speak,
Yes.
on a house.
Yes.
There's some inventory, there's more motivation, and it's just a good time. You can get a lot of scenarios allow you to negotiate in some seller paid closing costs. Rates are
Yep.
at a decent place. And I would also caution people about when I just like sparked a thought on seller paid closing costs. Really make sure you're talking to a professional and knowing your options, because it's not always a good thing in a market where rates can be declining to do permanent buy downs. So some of these
Mhm.
offers that you see out there for rates, you'll see rates offered with a 499 or 5 something, but they come with 2, 3, 4, 5 points. And in most scenarios, doesn't make sense, especially when
No.
rates can gradually come down and you're like, you to recoup the cost that you pay to permanently buy it on a rate, you got to really know the math and be confident in it, because
Mhm.
some of these scenarios I see, it's like 5 years, and most people don't keep a mortgage for 5 years regardless of the interest rate of it. They are either moving, selling, refinancing, cashing out, doing something, and it's just money wasted if
Yeah.
you pay too much and you don't really think it through.
I'm a way bigger fan of the temporary buy downs.
A
So
hundred
then if
percent.
you like refi, you get that
You
money
get
back.
credit for it.
Yeah,
Yeah, it's
especially
like
if
no
you
money
can get the
lost.
seller to pay for it. You're like, yeah, that's feels like a
Exactly.
total win.
For sure. 100%.
Okay, so do I have this correct? Like, Chairman Powell, like, is his term ending in 2026, May of
Yeah,
2026?
May of 2026, he is out. I think it doesn't matter where you sit politically. I think everybody realizes that our current administration is not a fan and they will not be appointing him to another term. So we
Okay.
will see a new Fed chair in 2026. But don't expect that to mean that we're going to see a huge policy change, because the Fed is still made up of a board of governors and Powell still sits on the board of governors.
Okay.
And the way the board of governors changes is they all have terms, and they have terms of when they are voting members versus non-voting members. So not all of them sit on the voting board, but they go through. And next year we don't have some big changeover. So I don't think that it's realistic to think there's going to be some huge change in policy. So a lot of it is rhetoric when you hear that on the news about expect things to change and we'll demand rates go down and whatever. And I mean, I guess anything could happen, but if we're going to just watch the reality of it and how history repeats itself, there's probably not going to be some big revelation. It is going to be there'll be probably a lot of lip service that we see in politics about appointing this new person is going to change our lives, and then shocker, they're going to get in and it's not really going to change our lives. So
We're not even gonna go down the political route, but yeah, you know what I'm thinking. It's like that's kind of how it is all the time. From your perspective, how do you see the interaction between interest rates and the housing market in 2026? And like, what trends do you think are going to emerge?
So I was looking at something earlier this week that home sales are expected to rise by about 9% in 2026. And in that is obviously good. A lot of that is just that balance of inventory that we're getting back, right?
Mm-hmm.
Like we couldn't have that same amount of rising home sales because we had such a massive inventory shortage. And granted, like some markets are better positioned than others, and some maybe have a slight oversupply, but not really. I mean, nothing like we did back in the 2008, 2009,
Oh
2010
yeah, yeah.
times. So I think that correlation is with rates continuing to be here. I think most people have adapted to rates, like the realization that rates are not going to be 3% again. They're not going to be 4. They're probably not going to be 5 without points, and you might get a 5 handle, but it's probably going to be 5.9, which is 6%. So the fact, I think that some of these, it's the perfect storm in a good way of the home sales rising, those predictions, because of the softening in the interest rates. I think there is going to be probably some slower growth in home prices, but on your side of the fence, I'm sure you see this. Any balanced economy doesn't support home sales compounding at like 10% or home values compounding at like 10% a year.
Mhm.
A couple percent a year with some swings here and there is good, but it's still not a bad thing or a bad market. I'm like, it's actually a really good market when you look at what's predicted to come
I
in
always think it's
2026.
catastrophic, like when during COVID and during the pandemic, when everything, like it was like one of the front page things of the Star Tribune here in Minneapolis, where it was like 15% appreciation. I'm like, that's not good.
No,
I mean, awesome.
no,
Your sellers are like, oh my God, my house went up so much. Yeah. I mean, yeah, you think that that's great, but that's not sustainable. And so then what happens? Then all of a sudden there's one little shift in the market. And all of a sudden, if somebody has to do a price reduction, everybody thinks the sky is falling. So I'm like, it's not helping temper anyone's expectations or have any sort of sustainability when that's happening.
no. And the other part of it that is like really easy for people to not consider is if home prices went up and you're going to sell your house at top dollar, that's great on what you're going to get. But then remember, you have to buy something or move somewhere else. So you're selling at top dollar, but then you're buying at top dollar. So
Yes.
you don't
Yes.
win on both sides of it. I mean,
Yep.
it's not really how the reality of it is. And finding balance in there and just being happy with what you could get in the reality of it. And I also like, it's a good thing to not have these price wars that we did, because some of that created like that 15% appreciation is
Mhm.
created because we had no inventory, and someone would go down the street and say, oh, your house is listed for 500, I'll give you 650 cash tomorrow. And it's like, that's not a $650,000 house.
No.
It's a $500,000 house. And just
Yeah.
because someone paid for it that day doesn't mean that that is sustainable. So, like, things do have a ceiling. You can't expect. Could you imagine living in a world where that 2-bed, 1-bath, all of a sudden, if we thought that it would just keep appreciating, that it was $1 million, in Minneapolis? No, that's ridiculous. You can't have a starter home with unlimited appreciation. You can't live in a world that would work.
Well, yeah, because nobody's jobs or income or any of that is
You don't have wage
growing at
inflation
that.
that goes along with that. Like,
Yeah, no. So I mean, that's just it's not good. That isn't good for sure.
yeah. Yeah, and we're seeing, and just on the rate side of it, we're seeing refis again, like a lot of refi opportunity, and it's normal. And then a lot of cash out refi opportunity too, because people do have equity, and there was a lot of debt coming off of the pandemic and people without jobs and hurting in this economy and whatever. So refinancing at 6% or 6.5% for a lot of people is still a great thing too.
I was wondering that when you said like credit card debt is like an all-time high, I was figuring you guys are probably seeing a lot of refinances.
Yeah, a lot more than we have seen in previous years. But this is interesting too, and this is a culmination of so many things, but we had our best month in October post-pandemic, like in
Wow.
over 3 years, 3.5 years.
That's so like to me, it's not surprising to me because there's a lot of agents that had really fabulous Octobers too. But I think just like if you're not in the industry, I think people will probably be surprised by that. Like,
Yeah,
well, interest rates aren't 3% and 4%. So like why who's doing business and why is that happening?
exactly. Exactly. There's a lot of that question. And it is like, I have such a love-hate relationship with the news because like we need it, right? Like we need to be informed, but there's so like the path that most information is delivered is that sensationalized headline,
Mm-hmm.
which is to catch someone's eye. And then if you were actually to read it, you'd read that it really didn't align with what that catching headline was.
Mm-hmm.
But we're in a world of like, triple tasking and looking here and looking there and catching the headlines only. So then everybody gets these misnomers in their head because the news is like housing's tanking. And it's like, no, the article was home prices have softened and some markets are flat and some, at up 2%, but not up 5%. I'm like, they didn't say the market was tanking. They just said it's flat, like it's not. Flat and a crash are two Very different
Totally
things.
different conversations.
Yes.
How do you think the buyer sentiment will change in response to like interest rate fluctuations like in this next year?
I think it's right now the biggest focus of what we could do for this in general is education, because I think everybody's still waiting when we talk about fluctuations and sentiments. Like there's like a mindset of these fence sitters want five handles to come in, and thinking that rates are low and need that, or like there's going to be some, or that if they're not low, that they're going to get a deal. So I hear a lot of that.
Yes.
Like if rates are low, then I'm waiting for a deal. So now since rates are coming down, the market's going to crash. So I'm going to wait to buy a deal. And it's like, the market's not going to crash like that was there. There isn't going to be a deal. You're not going to get that 2009 deal of the foreclosure for $80,000 for your single family home. Like those days are so long gone.
Yeah.
So I think we have to continue to educate in whatever forms we can to get out there with the reality of rates and focus on payments and that, because sitting on the fence right now and waiting, the only certainty you're going to get out of that is things are going to get more expensive, because home prices are going up. Yeah, they're not going up 10%, they're going up 2%, but 2% is more expensive than where it sits today. And every day you wait, if you truly are in a position and wanting to buy, you're just guaranteeing that you're going to pay more in one fashion or another.
I mean, I'll never forget. I had this couple come into an open house. This was like in the height of COVID. And they're like, we sold our house because we thought it was going to be, that was like top dollar sale. And then we decided to rent for 6 months, and come to find out they're like, houses are more expensive. Like, that's when houses were still going up like 8 to 10% a year. And they said, so now we could have gotten like probably 10% more for our house. And they said, and now we're living in a rental and we're realizing that we're almost priced out of the market. And I'm like, I was not their agent. And I'm like, I don't even want to know who your agent was, but that was really bad advice. But I think they were like kind of waiting for the sky to fall. And I'm like, now like 4 years later, it still hasn't fallen.
No. Yeah. And that's that too. When you think about that with that advice, even when it comes to like renting, there was a bit of a school of thought that you'd be better to sell your house at top dollar and then rent and wait till something comes along and you have that real life scenario of that couple. And then when you think about it, when you're renting, a lot of people say, well, I'm going to wait and rent until rates come down. Well, your landlord is probably paying 7 or 8% and you're paying their mortgage plus some. So, it's that you don't want to pay your own 6% mortgage, but you're willing to pay someone else's 8% mortgage right now. Like, it's like, stop and think about the perspective of it. Like, if you're in a position to buy, really look at the payment, not the rate.
You just literally jumped into my next question. So like, what else would you say to a renter that's like sitting on the fence, or maybe even just like dabbling with the idea of buying next year?
Like, look at it, because the other part of it is renting is not just, are you paying someone else's mortgage in the reality of it? You're never going to gain anything, no matter, and your rents are always going to go up. Like, we don't live in markets of rent control, right? So every year landlords are going to be increasing rents. And especially like if you live in a single family owned by a private party, maybe they won't increase it every year, but I can guarantee you if you're living in a rental unit in a large apartment complex owned by a corporation, they're increasing it every year. So it's getting more expensive and you get nothing out of it. And if you there's a lot of different ways to buy a home right now that don't require a lot of down payment. So if your finances are together and it makes sense, you are better off to buy and own, because you're gaining equity in that. And your payment, once you buy, if you buy on a fixed rate mortgage, you lock in your mortgage on a fixed rate, your mortgage is never going to go up. Your taxes might, your insurance might, but your mortgage isn't ever going to go up. And you only have the potential of it going down if rates go down and you refinance. So it's not, there's more security than renting, and you're actually building wealth and doing something for yourself versus building wealth and lining someone else's pocket.
That's such good advice. Are there any specific mortgage products or financing options that you believe will get sexier and more popular next year?
There was a moment where ARMs were kind of having a moment.
I know, but it sort of didn't quite stick.
Because there's
which is
not
so
a big enough
weird.
delta in a lot of them, though, because when you
Oh,
look
yeah.
at it, it depends on the arm, but a lot of times the difference is like in the 5 and 7 year arms, it might only be a quarter between the
Yeah. Then
fixed
it
rate
doesn't really
arm.
make sense. I
Yeah,
remember
it's
back in the
like
day, I loved it.
absolutely. We did almost all arms, and even
Yeah.
like, and it was just conventional arms, and FHA arms used to be huge. We did just bring back the FHA arm products
Okay.
because there's a little more buzz around it. They're not taking off like you thought. So I think it's nichey, and there's a savvy borrower, if there's enough of a move in the rate for it, would be interested. But I'm still a really big fan of the temporary buy downs, especially when we're in a market where we've got some room to negotiate some seller pays to do those. When that works, they're great, and you can do a 3-2-1, a 2-1, a 1-0 buy down. And like we had skirted over at the beginning, it's your money. So if you don't use up the buy down funds and you choose to refinance, it's money we hold in an escrow account that belongs to you, that you go to apply to your next transaction. You didn't just throw it to the wind and it went away because you changed your mind on how long you thought you might be in your house.
Yeah, that's why, especially if there's still those houses out there that are going into multiple offers. That's happening in every market, but that's not the norm right now. But like, if you're looking at houses that have been on the market a couple of weeks, my God, even like 3 weeks or a month, those sellers are getting so nervous. They would
Yeah,
almost all consider some sort of buy down. And then someone could get that dream rate they want with a 5 in the front of it.
exactly. And they can start with that, and it can get them through whatever their kind of, a lot of it I feel like is a mental hurdle about
Yes.
it over the rates, like, because that's where I can't say enough, like, payment and affordability are what trump everything on that. And in making sure, there's a lot of guardrails in place, and making sure that you are informed and you really understand the payment in your budget. Like, it's also kind of a lost art of people doing an actual budget. And so, like, having a budget and understanding that. But if you look across the board at different things that we can do with our money to invest it in whatever real estate, I just keep coming back to real estate because it is a sound investment that grows at even when you take the big spike of the crash, we still, like, if you look from the crash to now, it's still a diagonal line that's continuing to go up. Even though it went down and back up, we fully recovered, and then some and then some and then some. So it's like with anything, in the stock market crashes, other things do, but it is a great thing, and it gives you security because you're also living in a home that provides shelter to you as well.
Right.
So
And you're not paying somebody else's mortgage when you're a tenant.
exactly. And not that, disclaimer, I'm obviously not a CPA, but there are tax benefits to owning a home that you don't have when you are a renter as well, that could apply depending on your scenario and your tax bracket and all of that, and that you should consider and look at. And that's why the whole thing about, like, mortgages shouldn't just be about the one transaction. It should be about, like, your holistic situation. And that's why it is so important to whoever you work with, make sure they're professional, because they should understand and be able to have conversations with you about impacts that it has with taxes, and making sure that you're aligned with, that you have a good strategy on taxes, and a CPO or a CPA or tax preparer, and a financial advisor if you've got money. Because when you look at the holistic plan for all of it, you really see how minute an interest rate itself is on everything, and how impactful equity is, your overall growth goals, what it looks like, what you should be doing to reach your goals overall.
That's really good advice. What other advice would you give to potential homeowners that are thinking about getting into the market as rates come down? And like, the market's going to heat up every spring. It does. And
For
that
sure.
spring's getting earlier and earlier every year. Like, what would you tell that home buyer?
I would say 100% be prepared, because if home, let's just say you think that there's a 15% chance that you want to buy next year, you should get serious about it now. And don't be like don't play like armchair realtor professional person by just like getting on Zillow and doing stuff like that. I mean, those tools are fun to like go look at houses, but it's like when I say get prepared, like actually talk to a realtor, talk to somebody that represents the market that you want to buy in so you can really understand the trends and get pre-approved. Like be ready, understand your situation and what could work for you, because if you do that first, you also aren't going to be disappointed when you go fall in love with a house that is so far out of reach for you potentially because you were just looking online and you loved the kitchen and how well it was decorated and whatever, and you didn't really realize that maybe $6 million was out of your $800,000 budget. But I mean, a little sarcastic, but doing things in the right order is so important. And I say I think you should be ready and be nimble, because we always see, like you talk about spring market heating up, but we always see these kind of like micro windows too, where like all of a sudden just within a week something can change in a market and there's like a couple houses pop up that might be priced really right that work for you, and at the perfect time we see a little micro dip in rates, and when you're ready and you've got everything done and you could move, you're not scrambling, and you're also not going to be overwhelmed if you're not scrambling like that.
That's what I'm like. That's always the worst scenario to be in. And so I love when I get opportunity to talk to buyers like 6 months, 9 months ahead of time. Yeah. I'm like, talk to the lender, I think people get really crunchy talking about money. I'm like, a lot of times. And I'm like, have that conversation right away. Rip off the Band-Aid, and it's never going to be as hard as what you think it's going to be. And then like we have everything in a row, because you just never know. I feel like in Minnesota, like we'll have like all of a sudden like a few warm days in spring, and there'll be like 5 houses that pop up and you're like, oh my God. Yeah. And then
my dream house is up, like the one that I've been wanting, and I'm not ready.
Yep.
There's something else that probably is like worth pointing out. A lot of things have changed, and even how people are pre-approved, and like these soft pull credit reports are what almost all of us use now to start. And that means you don't get a ding. You don't get a hard credit inquiry. So you can go in and you can get fully pre-approved. You can have findings ran. You can desktop underwriter, loan prospector, like the agencies, you can actually fully run a loan. You can lock a loan on a soft pull credit report, and the way things work on the traditional agency products that make up, the huge majority of what we would be talking about when we're talking interest rates of buyers today. So even if some people are like, I don't want to dig my credit, I don't want to have a hard pull if I don't think I'm ready to buy right away. You don't have to have one. You don't have to have anything that is a permanent inquiry, because when you do a soft pull, no inquiry is created because it's not converted to an actual hard inquiry yet. So you can get fully pre-approved off of that and be ready and not have to stress that I'm going to have 4 hard pulls on my credit over the next year because I keep updating my scenario because I want to be ready.
That's really good to know. Yeah, some people are really hyper-focused on that. And it's like, well, yeah, the better your credit score, the better everything's going to be with your loan scenario and your insurance and all that. So yeah, that's a great reminder that it's not going to really impact your score, but you're still going to have all the info that you need.
Yeah.
Yeah. Or you never know, you might have terrible credit and you need time to get it fixed.
Exactly. And you might need a plan. It might be a not right now scenario, and you have some homework to do for the next few months to get ready and monitor that. Yeah. But it's never too early to get ready. And and it's great to have all these online resources, but with that whole shift there, a lot of people like reverse engineered the process, and they fell in love with the house first and then wanted to back into seeing if they could buy it. And it's like, let's go back to the basics and be ready and get your ducks in a row and be on the lookout. Like when they work with you, you set them up on notifications. You can dial into exactly what they think they're looking for in the right markets, right down to like how many washer and dryers sit in the house, so they can start to see what's coming. But they should only do that when they're pre-approved and ready. Or
that is very sound advice. Okay, last question. Like looking beyond 2026, like what long-term trends do you see emerging in mortgage and housing that buyers and real estate professionals should really be on the lookout for?
I think and I don't know if this is trendy or not, but this is the reality. And I started with it, and it's something just to continue to remember. Even with all the Fed cuts and everything that's happening and all we talk about, 6 is normal for rates and not temporary. So it's not a short-term trend that really goes into the long-term play of it. So plan around that's what reality is, and don't get the next thing, don't get hung up on headlines, because there is, you'll see national price growth slow and it's very modest, but you might be in a market where it's hot and it might be 10% and it might be whatever. And it's like we say overall, if price growth is going to be 9, that means that there's some markets where it's 0 and some markets where it's 20. It just, it all depends. So be like those, and that's less a trend, but more of the statement of, you are always going to have like local divergence, and you're going to have splits in what that is. And I say, if we're going to make anything on trend, it is the work with professionals all across the board. Like, don't think like for sale by owner, I'm going to save money, or whatever this looks like, because there is a reason that people benefit from people who know what they're doing in all walks of life. Imagine, would you let me put Botox in your face? Think of it that way. I mean, you need professionals to do whatever you're going to do. You wouldn't say, oh my God, Elly's smart and she looks like she has a steady hand. I'm going to let her do my Botox, or maybe she can do my open heart surgery because she's going to do it for free. It's the,
Yeah.
we need people in our lives in all walks of them that know what they're doing and specialize in their lane. I think a trend we're going to continue to see, though, is really big incentives in new construction. So back to more trends. And that can be hard sometimes for people like on the resale side. Mm-hmm. It is what it is. And part of this is these homes were already built and there's extra inventory. And I want to be very mindful to say not too much inventory, not crash-based inventory, but there's extra inventory. And when you have these big builders, they need to move things. And they have such a large profit margin built in overall that it doesn't affect their bottom line if they give a big incentive. I mean, in fact, they price the home to include offering some of these big mm-hmm. incentives. And a lot of it is, it's a kind of a mental game around it, because people feel like they're getting a deal. So if they say, I'm going to give you this big, huge incentive and I'm going to buy your rate down with this, you didn't get anything for free. You paid for it in the price of your house. But it is a trend that's going to stick around on there. But it's like, just remember, everything costs something. So if it, nobody beat the market. It's like, we're not going to beat the house. This isn't, I'm not Rain Man playing cards. If something is too good to be true, looks too good to be true, it is. When you see these big incentives, you do pay for it somewhere, but they still are going to be on trend. And I think that we'll see from just a Fed perspective and whatever, I don't think we're going to see any new trends. I think we're going to see a lot of the status quo. So,
well, I feel like that's not the worst thing ever, though.
No, and it really isn't, because it's I sometimes feel like a broken record, but I'm like, we're not in a bad market. And it gets so, it's so taxing to hear people talk about, oh, it's so hard and the market's so tough and it's so bad. And I'm like, but it's not. We just had a taste of utopia when we had those record home prices and record low rates. I mean, that just mm-hmm. isn't it. And the more time that comes, that lands between then and now, the better that will become. But it's like, this is normal. The market that we're in now is better than the market was when I got into the business in the late 90s. Mm-hmm. It was, rates were in the 8% range and nobody batted an eye at it. And sure, I know home prices were lower, but wages were lower. We could argue everything was lower then. And the first refi boom was the first time rates ever went under 7, and we were locking people at 6.875, and then they bounced back up. But to your point earlier, they didn't drop again until September 11th, and nobody wants catastrophe.
No.
For that to happen.
Yeah. No. Oh my God. No, please, never.
Right.
Locked in my house for 6 more months. No, thank you.
Yeah, exactly.
Oh my God. Leave it at 6% and let's just call it a day.
Exactly. And keep going. And there's also, I do think we're going to see, though, and this maybe could fall into trends. There were a lot of people that held on to homes because of interest rates, of like, I'm never going to sell my home because I have a 2% interest rate or whatever. And that's a really bold statement to make that most people can't do, because life happens and you have different needs. Your family could grow, your family could shrink, your job, you could be relocated. People will not continue to hold on to homes just because of interest rates. I think that was a short-term thing of, there's just no other option for me. How could I ever let this go? And now people are settling into the reality of, I actually need to be in a home scenario that works for me. And it's probably going to mean sacrificing this low rate. But what does this low rate get for me if I've got 3 kids sleeping in one bedroom?
Yeah. I mean, that's the conversation I keep having. But I'm like, well, I mean, if you're so attached to this rate, we can turn that one property into an investment property. Like, well, I don't want to be a landlord. And we're like, well, I mean, those are kind of the 2 options.
Yeah.
And
but right in there, you say, people have options, and they've just got to, it's like there's a lot of choices out there and a lot of options. And it's also a lot of just like being grounded in understanding what's going on around you and going, things aren't bad. Like, things are not bad right now. And the world is never going to be as bad or as good as what social media or the news says it is at any given moment. And so it's like finding that balance, finding the facts, and being realistic about it is going to keep your mind in check and keep you from losing your marbles.
That's a good mic drop at the end. Well, Elly, where can people find you?
They can find me. I was like, please don't look that close on Facebook because I never check it. But it is, my handle on Instagram is at Elly Cummings, and that would be the same. I think it's the same on Facebook, LinkedIn. I'm out there. Follow. I try to put out a lot of good content.
You put out great content.
To people. So give a follow on Instagram, and you'll hear from me weekly, multiple times on different things of what's happening in the markets broadly and in more micro markets. But it really comes down to, it's always that same message too. I'm like, things aren't bad. Things are pretty damn good, and keep the perspective on that. And
then you're going to get great content with your cute puppy dogs.
Yes, and there's always some of that there. You might have seen them walk along behind me. And you get to see that I have yet to put up the pictures in my little office behind me that are still in a box from Minneapolis after we packed up that house. I knew exactly what I wanted to do on the wall. I just had procrastinated a little bit on getting that done.
You've got plenty of time.
Yes.
You've got plenty of time. Well, thank you so much for being here. Thank you for sharing your insight and all of your years of wisdom with us. And if you have any friends that are thinking about buying a house, like share this episode with them. Like, this is going to be a good episode to really get people to reevaluate being a renter, or give them the confidence to move forward in 2026 with a home purchase.
Amen.
Yeah. So until next time, bus bench babes, keep your face off a bus bench and keep being the badass boss babes that you are.
Okay, girls, are you feeling as inspired as we are? We're over here cheering you on because you just finished another episode of the Girl, Get Your Face Off a Bus Bench podcast.
If you want more, head over to girlgetyourfaceoffabusbench.com for show notes and more episodes. And don't forget to subscribe and leave us a 5-star review. They mean the world to us, and they're what keep us going.
Girl, thanks for being here.